If you were born before 1964, the day you turned 65, you crossed an invisible legal line. You quietly moved into an entirely new category of the American financial system. But here is the brutal truth. Nobody whose job it is to hold your money is ever going to call and tell you the rules just changed. Right now, in 2026, three specific financial rules have quietly shifted for older Americans. One gives your local bank the legal power to lock you out of your own checking account for weeks, without your permission. Another is a hidden tax trap, where seniors hand the IRS a massive interest-free loan out of pure habit. And the third is a rule quietly draining your Social Security check before the money ever lands in your account. My name is David Taylor, and welcome to Senior Money Brief. For years, I have sat across the table from retirees who did everything right. They paid their dues and played by the rules. Yet, I watched them lose thousands of dollars every year simply because no one told them which forms to file. Here is the most expensive misunderstanding in retirement. Being legally exempt from a bill and actually not paying it are two completely different things. The gap between them is usually a single piece of paper. The government agencies collecting your money are not legally required to mail you a letter saying, "Congratulations, you can stop paying us now." They are perfectly happy to let you keep paying. They rely on your silence. Today, I am breaking that silence. I am going to walk you through all three of these quiet rule changes in plain English. And I need you to stay with me to the end, because the third rule is the most expensive trap on this list, and the absolute easiest to fix. Let us start with the one that catches honest people completely off guard, the new rule threatening your bank account. Imagine walking into the local bank branch you have used for 20 years. You step up to the counter and ask to withdraw $8,000 of your own savings to help your granddaughter buy her first car, or maybe pay a contractor for a new roof. But instead of handing you cash, the teller looks at a screen, makes a phone call, and says your account is frozen. For the next 15 business days, you cannot take out cash. You cannot pay your electric bill. You cannot touch a single dollar of your own money. Here is the part that should stop you cold. You did absolutely nothing wrong, and the bank is completely protected by law. Welcome to the new banking reality for Americans over 65. Under a new set of rules known as safe harbor laws, more than half the states in this country have handed banks unprecedented power. The moment you cross that age line, you become what the law calls a specified adult. The intention behind these laws was good. They were written to stop scammers from draining a vulnerable senior's life savings. If the bank suspects fraud, the law says they can freeze the transaction without needing your permission. And because of safe harbor protection, you cannot sue them if they get it wrong. But here is where a good intention turns into a nightmare for honest retirees. The bank does not have a human being carefully watching your account. They use artificial intelligence. They use computer algorithms to monitor what they call your financial heartbeat, the normal, everyday rhythm of how you spend your money. The second you break that rhythm, the computer throws a red flag. Suddenly taking out $10,000 when you normally withdraw $200 a week? Red flag. Logging into your account from a brand new tablet your kids gave you? Red flag. Writing a large check to a contractor you have never paid before? Red flag. The computer does not know you are fixing your roof. It only knows your behavior changed, so it triggers an investigation freeze. That hold is usually written into the law as up to 15 business days. Business days do not include weekends or holidays. That is 3 full calendar weeks without your cash. This is happening to careful seniors every single day. So how do you stop it? There are 2 simple, free moves you need to make right now. First, never spring a large, unusual withdrawal on your bank without warning. If you are going to take out a big chunk of money, call the branch a few days early. Say it out loud. I am taking out cash on Friday to buy a car. Announcing it in advance puts a clear, innocent reason on your file, before the computer invents a suspicious one. Announced money looks safe. Surprise money gets frozen. Second, and this is the absolute lifesaver, set up a trusted contact on your account. Almost every bank allows this, but nobody tells you to do it. A trusted contact is simply a family member or close friend whose name and phone number you give the bank in advance. They cannot see your balance. They cannot move your money. All they can do is answer the phone if the bank is worried. If your account throws a red flag, instead of locking your money for 3 weeks, the bank calls your trusted contact. Your daughter answers and says, "Yes, Dad is paying the roofer. He is perfectly fine." The freeze is bypassed instantly. It takes 2 minutes to set up, and it is the best financial insurance you will ever get. Now, that protects the cash you already have. But what about the money you are actively handing over to the government without realizing it? Let us look at the second massive change. Let us talk about the IRS. There is a very quiet mistake happening at kitchen tables across America every single spring. Millions of seniors are handing the federal government an interest-free loan, overpaying their taxes by thousands of dollars, and calling it perfectly normal. This is not happening because people are bad at math. It is happening because the tax code quietly introduced a massive financial benefit for seniors, and almost nobody bothered to advertise it to the public. I am talking about the brand new senior bonus deduction. If you are 65 or older, you now qualify for an additional tax deduction of up to $6,000. And I need to be incredibly precise about this, because even some professional tax preparers are getting this wrong. This $6,000 is not a replacement for your standard deduction. It sits right on top of it. It is an extra layer of financial protection that wipes out up to $6,000 of your taxable income just because you reached your 65th birthday. If you are married, and both you and your spouse are over 65, that is $6,000 each. You get a $12,000 shield placed right over your retirement money. For a lot of folks living on Social Security and a modest pension, that shield is the exact difference between owing the government money and owing them absolutely nothing. But here is the trap, and it is a painful one to watch. The IRS is not going to automatically apply this for you if you do not ask for it. If you have been filing your taxes the exact same way for the last 20 years, your brain is running on autopilot. You assume your tax bill is what it always was. You keep withholding the exact same amount from your monthly pension. You keep paying the same estimated taxes. You are literally handing the government money you are legally exempt from paying. And the system will happily cash your check without a word. The fix for this year is incredibly simple. Before you sign your tax return, you look your preparer in the eye, or you check your online software, and you confirm that the additional senior deduction was fully applied. Do not assume. Verify. But what if you are hearing this for the very first time right now, and you realize you missed this last year? Are you just out of luck? No. And this is the part that feels like finding cash in an old winter coat. The law allows you to go backward. If you miss this deduction on a return you have already filed, you can file a simple amended return using a piece of paper called Form 1040X. You tell the IRS, I forgot to claim my senior bonus, and the government is legally required to recalculate your taxes and send you a refund check for the difference. We are talking about real, heavy money. A married couple could be owed a check for over $1,000 from a tax year that is already closed. Yet, day after day, I hear older Americans talk themselves out of this money. They hear the word exemption and immediately put up their hands. They say, David, my house is paid off. I have a little bit of savings. I am sure I make too much money to qualify for something like that. That sentence right there is the deadliest trap in retirement finance. It is the exact reason the middle class is losing more money to the system than anyone else. Let me show you why assuming you make too much is the biggest mistake of all. I know exactly what half of you are thinking right now sitting at home. You are watching this and quietly saying to yourself, David, this all sounds great, but I have a paid-off house. I have a pension. I am not rich, but I am doing okay. These government programs are definitely not for me. If that thought just crossed your mind, please listen to me very carefully. You are falling directly into what I call the middle-class trap, and it is the single most expensive mindset an older American can have. People tend to view financial rules in two extremes. They assume a video like this is only for low-income retirees who are barely scraping by, so if they own a comfortable home, they tune out. Or, they assume this is only for the ultra-wealthy with massive estates and expensive accountants, so they tune out there too. Both of those assumptions are completely wrong. The people leaving the most money on the table in this country are not the very poor, and they are not the very rich. It is the vast, comfortable middle. It is the honest retiree living on a modest Social Security check, maybe a small pension, and a house that has quietly doubled in value over the last 10 years. Why? Because the system ignores you. You make just enough money that social services do not check on you, but you do not have a high-priced wealth manager fighting for every tax loophole. You just quietly pay whatever bills arrive in your mailbox, assuming the numbers are correct. That $6,000 tax bonus I just told you about? Yes, it phases out for very high earners. but a massive percentage of everyday, middle-class seniors sit perfectly inside the income limit to get the whole thing. Yet, they disqualify themselves in their own heads before they even run the numbers. Do not let your pride or your assumptions talk you out of your own money. The rules apply to you just as much as anyone else. And you need to keep that guard down right now, because if you thought overpaying your taxes was frustrating, wait until you see the money being pulled directly out of your monthly Social Security check before you even get to see it. This brings us to the third and most expensive rule change of all. Every single month, millions of older Americans have their Social Security checks shortchanged before the money ever even reaches their bank account. You probably already know exactly what I am talking about. It is your Medicare Part B premium. For most of you, that premium is quietly pulled directly out of your check. In 2026, we are looking at roughly $185 to $200 vanishing every single month. That is well over $2,000 a year, gone. Most seniors simply accept this as an unavoidable tax on getting older. They assume there is absolutely nothing they can do about it. But that is exactly what the system wants you to think. There is a set of programs called Medicare savings programs, often bundled with a federal benefit called Extra Help. If you qualify, your state will literally pay your Part B premium for you. They do not just lower it, they wipe it out. That means those $200 stop going to the government and stay in your Social Security check. For millions of retirees, that is the single biggest raise they will receive all year. And here is the quiet rule change that makes this so urgent right now. The income limits for these programs have expanded drastically. When the annual cost of living adjustments hit recently, the financial thresholds moved up. This means thousands of seniors who applied 2 or 3 years ago and got denied for making slightly too much money now suddenly qualify for the exact same program. But nobody at the Social Security office is going to call you and say, "The line moved, you qualify now." If you do not apply again, they just keep taking the premium out of your check. It is your money, but they will gladly keep it until you raise your hand. And the savings do not stop at your monthly premium. The second half of this rule change is a massive financial shield for anyone taking prescription medications. For years, the cruelest part of the Medicare Part D drug benefit was that there was no real ceiling. If you were unlucky enough to need a very expensive specialty drug, you just kept paying. You could drain your entire life savings at the pharmacy counter. That nightmare is officially over. Starting right now, federal law has placed a strict, hard cap on what you pay out of pocket for covered Part D prescription drugs. For 2026, that cap is exactly $2,100. Let me explain how life-changing this is for a sick retiree. Let us say you need a medication that costs several $100s a month. Under the old rules, you paid that indefinitely. Under the new rule, your out-of-pocket costs start adding up in January. Your deductibles, your co-pays, all of it counts. The moment your personal spending hits $2,100, maybe that happens in May or June, the meter stops dead. For the rest of the calendar year, you pay $0 for your covered medications. Your plan is forced by law to pick up 100% of the remaining cost. For someone fighting a serious illness, that is thousands upon thousands of dollars in permanent savings. Now, combine these two things together. If you apply for Extra Help, your co-pays shrink drastically, and you might get that Part B premium put right back into your Social Security check. And even if your income is slightly too high for Extra Help, you still get the absolute protection of the $2,100 drug cap just by having Part D. But remember the rule of silence we talked about at the beginning. The government will not hold your hand and force you to claim these benefits. If you want this money, you have to take action. I am not going to leave you hanging with a bunch of abstract ideas. I want you to know exactly who to call tomorrow morning to stop your bank from freezing your cash, how to get your $6,000 tax deduction, and how to wipe out your Medicare costs. Let me give you your exact 48-hour action plan. Here is exactly what I want you to do in the next 48 hours. Grab a pen and write this down, because taking these simple steps is what separates the seniors who lose money from the ones who keep it. Action 1 is your bank. Tomorrow morning, call your local branch or log into your account. Tell them you want to add a trusted contact to your profile. Give them the name and phone number of an adult child or a close friend. That 1 5-minute conversation builds a permanent wall against the AI algorithm and guarantees your money will not get frozen if you need to make a sudden withdrawal. Action 2 is your taxes. Dig out the tax return you just filed or call your CPA. Ask them one direct question. Did I receive the new $6,000 senior bonus deduction?
If they say no, or if you filed it yourself and missed it, do not panic. Ask a tax professional to help you file a Form 1040X to amend your return. You can literally reach back into a closed tax year and pull your money out of the government's hands. Action 3 is your Medicare. Do not assume you make too much money. Pick up the phone and call your local SHIP office. That stands for State Health Insurance Assistance Program. These are free, unbiased counselors. Tell them, I am living on a fixed income and I want to be screened for a Medicare savings program and extra help. Let them run the math. That one call could put $200 back into your Social Security check every single month. And since you stayed with me this far, let me hand you one massive bonus move. Call your county tax assessor this week. Ask them if they have a senior assessment freeze on file for your home. In many states, the day you turn 65, you can legally lock your property tax value in place forever. Your home can double in value, but your tax bill never goes up. But just like everything else today, the county will not give it to you unless you submit the exact form. You now have the exact roadmap sitting right in front of you. But there is one final critical warning I must give you to protect yourself before you make these calls. Here is the final absolute rule you must follow. Never pay a stranger to do any of this for you. The moment a video like this goes public, scammers start dialing phones. They will call you, sounding incredibly official, claiming they are from Medicare or the IRS. They will tell you they can unlock your new $6,000 tax deduction or wipe out your Medicare Part B premium today if you just confirm your Social Security number or your bank account routing number. Hang up the phone immediately. The federal government does not call you out of the blue to hand you free money. The system is designed to reward the informed and to quietly take from the uninformed. You are now informed. You go to your bank. You call your own CPA. You contact your local SHIP office directly. You hold the power, and you do not need to give anyone a cut of your own money to claim it. Please remember, this video is for general education. I am giving you the landscape, but this is not personalized legal or tax advice. Your specific state laws, your exact income, and your personal situation will determine exactly what you qualify for. Always confirm your moves with a licensed professional or your local county office before acting. If this video opened your eyes, I need you to do one thing for me. Share it. Send it to a friend, a neighbor, or a family member over 65 who is living on a fixed income. They are almost certainly overpaying the government right now, and nobody is going to tell them unless you do. Subscribe to Senior Money Brief and turn on the notification bell so you do not miss the next set of rules. I am David Taylor, and I will see you in the next video.